This week, three things happened simultaneously that every investor in America should be paying attention to. Inflation just came in hotter than expected, 3.8% year over year, the highest reading in 3 years. The Federal Reserve just got a brand new chair for the first time in 8 years, adding a layer of uncertainty nobody has fully priced in yet. And the stock market is sitting at one of the most extreme valuations in 150 years of recorded history. While oil prices remain elevated due to an ongoing conflict in the Middle East that is not going away quietly. For most investors, this combination is anxiety-inducing and confusing. But for the dividend investor who is positioned correctly, it is one of the most compelling setups in years. Stay with me. I'm going to show you exactly why and what to do about it. Let's talk about what is actually happening right now, because the timing of these three things together is not something you can afford to ignore. First, inflation. The April CPI report shows inflation running at 3.8% year over year, the highest since May 2023, driven by an energy shock from the Iran conflict that sent gasoline prices surging over 21% in a single month, the largest jump since the index was first created. That is not a forecast. That number landed this week. Second, the Fed. Jerome Powell's term as Fed chair ended May 15th. Kevin Warsh is set to take the position, and markets are already adjusting to the uncertainty of a new communication style and potential shifts in interest rate policy. Futures traders now expect 0 rate cuts for the rest of 2026, a complete reversal from what was expected just months ago. Third, valuations. The Shiller CAPE ratio, which measures market price against 10 years of inflation-adjusted earnings, is hovering near 40 in 2026. There have only been 2 times in 150 years of history that it reached this level, right before the Great Depression and at the peak of the dot-com bubble. Each of these 3 things alone would be worth a conversation. All 3 at the same time? That is a signal your portfolio positioning deserves a serious look. Before we talk about solutions, let's be honest about the risk, because most people picture the wrong thing. They picture a dramatic single-day crash, something you can react to. The real danger is quieter. It is called a lost decade. Years of flat, grinding, going nowhere, returns that steal something you can never get back. Time. From 2000 to 2009, the S&P 500 delivered roughly 0 returns for 10 full years. Not a crash followed by a recovery. A decade of waiting. The same pattern played out from 1973 to 1982. A period of high inflation, rising energy costs, and an uncertain Federal Reserve. Sounds familiar? Every single one of those lost decades was preceded by stretched valuations, strong corporate earnings, headlines, and investors who felt completely fine. This matters most for the investor between 40 and 60 years old. If the next decade delivers close to nothing, not a collapse, just flat, you reach retirement without the compounding growth you were counting on. There is no reset button. The investors who came through those periods without losing ground had one thing in common: income that kept arriving every single quarter, regardless of what the market did. Here is what should genuinely get your attention. SCHD is not just surviving this environment. It is thriving in it. Year to date in 2026, SCHD has delivered a total return of over 16% against the S&P 500's roughly 7% gain over the same period. The rotation into dividend stocks and quality value is happening right now, in real time, for exactly the reasons this video is explaining. Why is SCHD built for this? Because of how it selects its companies. To get into this fund, a company must have paid dividends consistently for at least 10 years, show strong cash flow, carry manageable debt, and demonstrate solid return on equity. That filter removes the speculative and the overpriced, and leaves behind companies like Chevron, Coca-Cola, Texas Instruments, and Merck. While the S&P 500 trades at 28 times earnings, SCHD trades at 18 times earnings, and SCHD currently yields 3.44% against the S&P 500's 1.03%. That is more than 3 times the dividend income from the same dollar invested. Here is what makes this even more relevant right now. SCHD's energy holdings, Chevron and ConocoPhillips, are direct beneficiaries of elevated oil prices driven by the Iran conflict. The same geopolitical event that is making most investors nervous is actively working in SCHD's favor. Here is the concept that separates long-term SCHD investors from everyone reacting to the news cycle. And it is why this strategy gets more powerful over time, not less. SCHD's annual dividend has grown from just $0.22 per share at its 2011 launch to over $1.05 today, a nearly five-fold increase in 14 years. Early investors who bought at launch and held are now collecting a yield on cost above 12% annually, meaning their original investment generates over 12% per year in dividend income alone, without selling a single share. When you reinvest those dividends through DRIP, the dividend reinvestment plan, each payment automatically buys more shares. More shares generate a larger dividend. That larger dividend buys even more shares. The engine runs every quarter, whether the market goes up, sideways, or down. In a flat or falling market, this becomes even more powerful. Lower prices mean your dividends buy more shares per dollar. The environment that hurts a growth investor actually accelerates the compounding cycle for a dividend investor. SCHD has raised its dividend every single year since inception, with a 10-year dividend growth rate of nearly 11%. A new Fed chair cannot stop that. Inflation cannot stop that. Geopolitical uncertainty cannot stop that. The dividend keeps growing, the compounding keeps running. The picture right now is unusually clear and unusually urgent. Inflation is re-accelerating. The Fed just changed leadership at one of the most uncertain moments in years. The market is at extreme valuations, and the exact strategy built for this environment, quality dividend investing, is already outperforming. You do not need to panic. You do not need to overhaul your entire portfolio. What you do need is an honest answer to one question. If the S&P 500 goes nowhere for 5 years or 7 years, does your portfolio still build wealth? For a dividend investor with SCHD, DRIP turned on, and consistent contributions, the answer is yes. The income keeps coming. The share count keeps growing. The compounding keeps accelerating. The investors who built real wealth are never the ones who called the top perfectly. They are the ones who had the right system already running before the uncertainty arrived. That system exists. The data shows it is working. And right now, with 3 alarm bells ringing at the same time, that is exactly when it matters most to have it in place. If this video gave you clarity on something that felt confusing, hit that like button right now. It takes 1 second and it helps the community reach more people who need to hear this. Subscribe so you never miss a video, and drop one comment. Given everything happening right now, new Fed chair, hot inflation, elevated markets, are you holding SCHD, adding more, or just starting your dividend journey? I read every single one. Keep investing simplified. I'll see you in the next one. InvestED content is for education only, not financial advice. Always do your own research.